Why does it take so long to build a home? In today's Property Insider chat, we're going to explain that today it takes about 40% longer to build a home than it did 15 years ago. And for apartments, it's going to take considerably longer, considering all the red tape, green tape, finance issues that are going on. It's moved from 18 and a half months from approval to completion to a staggering 33 months. Of course, this is going to only add to the cost of new dwellings and make the supply-demand ratio even worse. But before we discuss that, Dr. Andrew Wilson and I are going to discuss the latest inflation figures and what that means for interest rates. And Andrew Wilson's going to tell you when he thinks interest rates are going to come down. And it may not be what you think. And we're also going to discuss the latest building approval figures. So if you want to keep up to date with what's happening in our housing markets, why not subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. What's ahead for property? Well, into 2025, clearly a lot's going to have to do with what happens to interest rates and when they start to fall. The Consumer Price Index is now at the lowest level since March quarter of 2021 and well below its peak of 7.8% at the end of 2022, meaning any talk of further interest rate rises is now off the table. So the question is, when are rates going to fall? That's what I want to ask Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider chat. And I'm also keen to get his views on the latest building approval figures, which of course are a leading indicator to watch so that we know what's ahead for our housing markets. Hi, Andrew.
Yeah, good day, Michael. And we had some interesting inflation data out, reasonably predictable, really. And we've discussed this before, that the key drivers have been the decline in the price of oil. We all should know about that because prices at the bowser have been significantly lower than where they were a year ago. And we've also had the policy from the government announced in the budget in regard to electricity bill handouts has also had a big impact, as it was planned to do. I'm not quite sure we're getting there as quickly towards the target as the government was hoping, but nonetheless, certainly heading in the right direction. But I noticed, Michael, just today that the price of petrol is now above $2 a litre again. I'm not sure.
Yes, it's jumped up, hasn't it?
What's going on there, whether I'm in Melbourne at the moment and whether that's a Melbourne holiday, because it is the holiday period for the Melbourne Cup at the moment, whether that reflects that. But I was a little surprised given, as we'll see shortly, the price of oil continues to fall.
Well, Andrew, there are two measures of inflation, and that confuses some people. So there's maybe you could explain what the two are and which the Reserve Bank pays attention to.
Well, actually, there are four measures, Michael, not just
Aha.
two, because we have, which is even more confusing. But if we look at the individual results monthly, we have obviously the headline rate, which takes account of all the items in the basket of goods. And then we have the underlying rate, which takes out the volatile elements that do change due to seasonal factors. And of course, those volatile elements are particularly fuel and also housing and food. So there are the two measures. And I guess to put it in real context, the Reserve Bank is quite clearly, and before I say that, we also have the quarterly data set, which is, I guess, the big version of the inflation rate data. The ABS has said that it's not really, in terms of its robust nature, at the same level, the monthly data set compared to the quarterly data set, but it's working towards that. But we've got to say that the quarterly data set is the one that's favoured. The Reserve Bank has said that's the one that it favours in terms of its interest rate decisions. Because it is more robust. But it is a backward-looking set if we think about it, because it is looking back 3 months, whereas the monthly data set, which we report here every month, and it gives us a more, I guess, real-time insight into what's happening with inflation. That monthly data set is, it's not the one that's being regarded, apparently, according to the Reserve Bank, as the one that they're going to focus on for their interest rate decisions. So a little confusing, but we will continue to focus on the monthly data set in terms of the overall picture, but we'll also, in terms of the interest rate outlook, look at that quarterly data set, because that's the one the RBA has told us that it's the one that it will be focusing on. So let's have a look at what happened over September for the inflation rate. Another sharp decline in headline inflation. So that's the inflation rate that accounts for all the factors in the basket of goods that the ABS measures. 2.1% growth over the year in headline inflation over September. So that's September this year versus September last year. Prices up 2.1%. And as you mentioned, Michael, that's well below the 7.2% peak that we had during this current cycle. And it's well down again on what we reported over August, what the ABS reported over August, which was 2.7%, which again was a sharp fall compared to July. However, underlying inflation, which discounts the fuel, housing and food, was down, but it was still at 3.2%. That's down from August's result of 3.4%. So the main factors over the year were housing up 1.6%, but again, lower than the previous month's 2.6% over the year. Food up 3.3% over the year compared to the previous month's annual result of 3.4%. But the falls were due again to a sharp fall in the price of fuel, down 14%, Michael, over the past year, which was even a sharper decline than the 7.6% fall recorded over the year to August. And our electricity was again down a record 24.1%, which of course is due to that government subsidy announced in this year's budget. So big falls in fuel and electricity, but of course, when they're excluded from the data, we get that much higher rate of underlying inflation. The RBA has said that its target range for inflation is 2 to 3%, and as I mentioned, they are looking at the quarterly data set rather than the monthly data set. And when we look at the quarterly data set, that's the September quarter, we have underlying inflation tracking at 3.5%, Michael. So that's certainly higher than the monthly. No surprise there, because we've had that big fall over September in fuel costs and well ahead of the 2 to 3% target. Now, in terms of the interest rate outlook, we're certainly getting closer to the target range, 2 to 3%. But the Reserve Bank has quite clearly said that it needs to have a sustained period of inflation within the target range, 2 to 3%, before they would consider a cut in interest rates. Now, of course, this may change, but that's the current announcement by the Reserve Bank. Now, of course, we will have an imminent meeting by the Reserve Bank to determine what's going to happen with
Well, by the time people watch this, the result will be known, Andrew. But the bottom line is all the banks now, and we know that they're not that good with their forecasting, have actually changed their forecasts. And CBA, the only bank that suggested there would be an interest rate fall by the end of this year, has now moved it forward to February. So ANZ, CBA, NAB and Westpac all believe that the cash rate is going to drop by 0.25% in February. Some think there'll be 3 rate drops, others 4, others 5. I guess nobody really knows where it's going to end up, where that Goldilocks figure, which is not too high and to dampen the economy, but not too low to stimulate inflation, is going to be. But I guess it's all bets are off for this year.
Well, absolutely. And we've said that all along, Michael. And
I know that's what you've been saying. That's partly why I said the bank's forecasts have been interesting, despite all the economic data they've got and the great teams they've got behind them.
And I think, tongue-in-cheek, the banks have really turned mistaken forecasts into an art form, regardless of whatever it is. But they have a bit of a vested interest in the outlook for interest rates. Perhaps that's a get-out-of-jail card for them. but they certainly continuously get it wrong in terms of their forecasts, as you said, regardless of the resources that they have to throw it at. But if we could look at the outlook, perhaps, Michael, and I think this is interesting in a logical sense, using the knowledge that we have at our disposal. And as I said, the Reserve Bank has said that it needs to have a sustained period with the underlying inflation rate within the target range. That's 2 to 3%. Now, the next, we're not there yet, so we certainly can't say that we've had a sustained period. We're not there yet. The next quarterly data set is the December quarter. That will come out towards the end of January. It will be before the February Reserve Bank meeting. Even if we were to get underlying inflation within the target range then, and that would take a pretty big fall, but if we do get it within the range there, it's not going to meet the conditions stated by the Reserve Bank of a sustained period of interest in the inflation rate within the target range. So I think that even if we did get a good result over February, over the December quarter, I don't think it will be in time for the February result. It will be in time for the meeting, but it won't meet those preconditions as stated by the Reserve Bank. Now, they may change their mind, but we can only go on what they've stated. And it would be perhaps a little premature just to go off on one quarter's result. But the next inflation rate data will come out for the March quarter, and that will be released towards the end of April. So that would be in time for the May Reserve Bank meeting. So I would suggest if we did get another, and we're really speculating here, another quarter of inflation within the target range, 2 to 3%, that's when the Reserve Bank would act. And I think rightly so, given that they don't want to jump the gun, and that it would look like they were flip-flopping a little bit on their stated determinants for lower inflation. So at this stage, we could say, for lower interest rates, at this stage, we could say that all things continuing on the current trend, that we may have an interest rate cut announced in the May meeting of the Reserve Bank. So I think that's sort of logical in terms of what we know and the data as it stands at the moment. But I think it's way too early to be talking about, and given what the Reserve Bank said about an interest rate cut in February. So perhaps we can look forward to some more changes in those bank forecasts between now and then.
Well, over the last month, there's been lots of ABS data coming out, and one of the ones I know you keep careful watch of at My Housing Market are building approvals, because it's what we call a forward indicator. It gives us an indication of what's ahead, not that all approvals actually come to fruition, but what did the last set of numbers show?
Well, typically the volatile set of building approvals continued on its up and down journey, Michael, after a big fall over August, down 5.7%. This is national home building approvals. We got a rise of 3%. So it wasn't quite as volatile as we normally see. Units were up, which is what we see from month to month, but they're only up by 4.7%. But houses have continued their upward trend of the past year, and they're up 2.2%. So up 3%, but not really improving over the decline that we had over August. Queensland was the top performer. Total home approvals up by 14.3%. But annual growth levels still remain depressed. The quarterly trend is low but rising, and that's basically on the back of a recovery in house building approvals. And when we look at the breakdown of houses and units, over the month, houses were up 2.2%, units were up 4.7%. But when we look at the longer term journey, it gives us a better picture that houses so far this year, approvals for houses are up 9.2%, and over the year-on-year comparisons up 6%. So some healthy numbers there, Michael, but units continuing to fall over the year to date versus the same period last year, down by 8.4%, and the year-on-year data are down 11.6%. So better news for houses, but still, a tough journey ahead there for unit development. And even those unit approvals will take some time to become, those that do become commencements will take some time to become completions. But the overall national trend is now higher than where it was a year ago. And as I said, that reflects the breakout in house approvals, which is a positive thing, for our resupply, but we're still sort of trundling along the bottom. And when we do compare units with houses, the trend is still well below for units where it was a year ago, although houses are higher than where they were a year ago. So that's the problem. Units are dragging the chain, houses are reviving, but the overall picture is still one of clear undersupply. And when we compare the capital city results, Melbourne's still well and truly the engine room for home building approvals. Interesting when we look at approvals for houses that both Brisbane and Perth continue to outpace Sydney. Of course, they're significantly smaller capital cities. And in fact, Perth now is approving more houses than Brisbane. So that Perth...
Wow. Now, interestingly, today, the Master Builders Association brought out some figures that explain partly why we've got such an undersupply. Looking back 15 years ago, the average time it took to build a standalone home from approval to completion was about 9 months. Fast forward today and it's stretched to a whopping 12.7 months, a jump of over 40%. And that's just houses. For apartments, and we've mentioned this often, the time from approval to completion has exploded from an average of 18 and a half months 15 years ago to 33.3 months. That's nearly 3 years to bring in a single apartment to life, an 80% increase in timeline. And we know part of that is just finance issues and getting things sold off the plan. But this blowout isn't just an inconvenience, Andrew. It's obviously worsening our housing shortage, and the long timeframes must add to the cost of getting dwellings out of the ground, Andrew.
Well, it's just something that adds to all the other roadblocks that are confronting housing development, particularly planning restrictions, red tape, green tape, and of course, the actual high costs of building, which are continuing. They're not rising at the same rate, but they're still rising. So it's like the old story with inflation is inflation doesn't actually reflect what the price is. It reflects the change in price over a period. And house building costs are still up 50% from over the past 2 years, even though the rate of growth is not declining, but it's not as strong as it was. And as I said, these are all part of the systemic problems that restructuring our housing market is confronting, and that's why when we look at some of those targets that the Reserve Bank and the government and also the master builders and housing associations as HIA have predicted are still well below what we're actually seeing at the moment. And, it'll only be exacerbated by those factors you just mentioned in terms of the time it takes to complete an approval.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. We always look at auction results too, because that's a great in-time indicator of how buyers and sellers are feeling. It was a funny weekend. Melbourne, being one of the big auction markets, was almost on our religious holiday of Cup Day. So Surprisingly, some people still put their properties to auction. How did the auction markets travel over the weekend, Andrew?
I'll have a look at the weekly results because we did have a hiatus for Melbourne. I guess it's their second religious holiday in about a month following the AFL weekend. But similar result. But we look at the weekly weekly numbers. It was interesting that Melbourne had a big fall, but the other capitals actually numbers were higher generally over the week compared to the previous week. So the holiday spirit, the religious holiday spirit wasn't captured in the other capital city markets, but we are starting to see and we're into the last phase of the spring selling season, Michael, now, which runs from that Melbourne Cup holiday weekend all the way through to the end of the year. So we've got about 6 weeks of results left, weekend results or weekly results left. And we typically see the balance between supply and demand shifting in favour of supply. There are various reasons for this. Sellers become a little bit more motivated to clear their properties before the end of the year. There are fewer buyers because buyers have, undertaken their purchases to a large degree to this period. So we do see lower clearance rates as a result. I think we're starting to see that now over the last couple of weeks. And again, it was a similar story last week. Sydney was around about the same 64% clearance rate, down from 65, but certainly well below the 70% of a month ago. Melbourne actually improved its clearance rate, but it was a holiday week, so we take that with a grain of salt. But nonetheless, above the mid-60s for Melbourne. We are starting to see a little bit of an improvement in those higher priced areas in Melbourne, which have been dragging the chain. We're talking about the inner east, the inner south, and the inner city. But not a lot of time left for the sellers to find a buyer in those areas. Brisbane's actually fallen backwards over the past month or two, Michael, from the mid-50s into the 40s. And it was, again, another lower result for that Brisbane market. But we always discount to some degree auction clearance rates in Brisbane because it does have a different auction culture compared to the other capital city markets. It tends to be more a part of the private sale mechanism rather than what we would describe as a standalone auction marketing technique. Adelaide also has been a little lighter recently, 68% clearance rate, certainly falling from the 70s over the past month and well below the 80% plus that we were used to calling Adelaide. And Canberra also down over the week compared to the previous week's result with similar numbers. So, Michael, I think that what we're seeing here is the usual easing in clearance rates because of more supply and less demand over the final weekends or the final weeks of the auction season, of the spring selling season. And also that's been shown in, as we discussed last week, with some easing in prices growth, although overall prices growth certainly remains positive in most of our major capital city markets, but not at the same rate that we've seen earlier in the season and, of course, earlier in the year. But that's just the cycle doing its thing as it starts to peak out. But still plenty of confidence in our housing markets. And, out there, it's always regarded as a better time to buy towards the end of the spring selling season compared to the beginning of the selling season because of that changing match between supply and demand.
Well, we'll see how things go. There's only a few weeks left in the selling season. As you say, Christmas is coming up pretty quickly, but we'll be back each week to report on things. And the sentiment, the mood seems to be improving in general. Consumer confidence in all areas is ticking up just a little bit. We've had a long period of one hit after the other, the cost of living pressures, mortgage pressures, worries about recessions, inflation. So as people feel more confident, they're going to make those big decisions of buying a new home or buying an investment property, Andrew.
Yeah, Michael, and regardless of those ups and downs, one thing's been pretty consistent is increase in house prices over the past 2 years now.
It has.
Just about all our capital cities, particularly the major capitals.
We'll look forward to catching up with you again next week and seeing what's happening in our housing markets.
Thanks, Michael.